Good morning, everyone, and welcome to today's webinar. This webinar is one leading to the Corporate Valuation Masterclass. I'd like to call it a teaser to the masterclass. My name is Tomiwa Ojo. I am an assistant manager within the Deloitte Financial Advisory Practice, and I'll be anchoring today's webinar conversations. We have our audience today. We have as our audience today about 1,000 registered participants, including CEOs, CFOs, finance directors, and other business leaders. Today's webinar is organized by the Lagos Business School of the Pan-Atlantic University in collaboration with Deloitte Nigeria. And the objectives of the webinar are, one, to provide a window into the upcoming Corporate Valuation Masterclass. The masterclass is scheduled for 2nd to 4th of September, and we'll be talking about the webinar much later. We would also discuss leading topical issues and techniques for valuation in today's business world. And we'll attempt to explore some real-life insights of practicing valuation professionals. I'll take us briefly through the agenda for today. To set the scene, we have Mr. Segun Thomas, the Head of Programs, Development and Innovation at the Lagos Business School, to set the scene, after which Abimbolo Gundare, a partner in the Financial Advisory Practice of Deloitte Nigeria, and the Deloitte Africa Corporate Finance Leader. She would run us through the applications of business valuation to business landscapes. Following that, we would do a deep dive into business valuation, and that will be taken by Ogenetejiri Ishaka, a senior associate, and Sulaiman Ishola, a senior manager in the valuation and modeling practice of Deloitte Nigeria. Having been filled with the appetizer, would be introduced to the main event. That's the Corporate Valuation Masterclass version 2.0, after which we would take questions from you all. And rest assured, your questions would receive the right attention. By way of housekeeping, this webinar has a chat section. Do not hesitate to drop your comments and reactions in there. Should you have questions, please do well to utilize the question and answer section. You'd see a Q&A section right there, and we'll be sure to attend to them at the appropriate time. I'm very convinced that you'd have a great session today. Over to you, Mr. Segun.
Thank you very much, Tomiwa. Good morning, everyone. If you can hear me loud and clear and you're excited over what is going to happen in the next 2 hours, I want you to go into the chat box and throw in some emojis, just to show that, yes, we are ready for the next 2 hours, the knowledge session, the knowledge you are going to be impacted, with. Okay, so my name is Segun Thomas. I work for Lagos Business School. I head the program development and innovation unit. Okay, so I say welcome to you all. This is version 2.0. We had a similar session last year and it was fantastic. We had a lot of feedback, great feedback from that session. So I welcome everyone and thank you for joining us on the very second version of the Corporate Valuation Masterclass. Whether you're an entrepreneur, you're an industry professional, or you just want to even seek your financial knowledge, trust me, you're in the right place and you're very much with the right hands. So of course, we all know that corporate valuation is the cornerstone of sound investment decisions, strategic planning and growth in your career. So understanding how to accurately assess a company's worth is critical in today's fast-paced business environment where decisions are often driven by data and long-term value. I would not want to bore you as to what to expect. All I want to say is welcome, sit back, and have a very fantastic 2 hours. I'm sure at the end of the session, it should be a worthwhile for you. So thank you and welcome on the journey. Thank you. Over to you, Tommy.
Thank you very much, Mr. Segun. We'll go now into the application of business valuation to business landscapes, and Abimbola Gundari would take us into that.
Thank you very much, Tomiwa. And thank you, Mr. Thomas. It's always a pleasure to collaborate with the Lagos Business School on the Corporate Valuation Masterclass. Welcome also to all of our online participants, our esteemed audience who have taken the time to spend a few hours with us this morning. I'm going to take us very briefly through the application of business valuation to the business landscape. By way of introduction, my name is Bimbola Ogundare. I look over our West Africa financial advisory business for Deloitte, as well as the Africa ex-South Africa corporate finance portfolio. Valuations are a way of life, I would say, and more specifically, a way of business for any entrepreneur, businessman, corporate looking to do anything from establish a basic benchmark of value or a baseline, all the way to prepare for tax planning, M&As, and so forth. So the real starting question is, why do we carry out business valuations? And we carry out business valuations so that at a certain point in time, we are able to say, this is the value of our business. Now, that might be for financial planning purposes. It might be for the purpose of financial reporting and carrying that business or that asset at the right amount on your books. It may also be in preparation for an M&A deal where you know that ultimately you need to determine a share for share exchange, and it's super critical that you're able to preserve value for both the acquiring entity and the acquired entity in a way that's transparent to all stakeholders. Now, performance management is one that we find quite often. Take something as simple as a new CEO assuming a role in a company and the board determining that the current market price is a benchmark for his performance. And in another 5 years' time, in order to determine whether he has done well or not, there will be another reference point to what the share price is at that time. It could also be used to determine his remuneration or his payout. For estate planning purposes as well, we have large family offices that decide that in order to transition from one generation to the other, all of the assets have to be properly catalogued, managed, and valued from period to period so that there is no value leakage between generations. And indeed, they are able to track the growth of generational assets. So these are some of the reasons why we may carry out business valuation at one point or the other. Okay. And in looking at business valuations across the different businesses or across the continuum of the life cycle of any business, there are different ways that one would look at valuation. So valuation for a startup will be very different from valuation for a steady state company. Why might that be? Very simply, a startup carries a higher level of risk for the cash flows. So we put in the cash flows, we estimate that things will go a certain way over the next 5 years, and then we start to put together everything that will drive those cash flows. We've all heard that risk and reward are commensurate. And so if the level of risk is higher, then we expect higher levels of reward. Now, that reward is what the equity holders or the debt holders will be expecting as a return. Therefore, if you take that as analogous to the discount factor, then the cash flows for a startup will be discounted at a much higher rate than the rate for a steady state business. When we go to other types of businesses, for instance, distressed firms, you may decide, look, this business is already distressed. I will not be able to rely on the future cash flows, because indeed there is already a dark color on whether those cash flows will materialize. Perhaps what I want to look at is the realizable value of all the tangible assets. Even the intangible assets may be impaired just because the company is already distressed. Therefore, in looking at valuation for these types of companies, you may lean more towards the asset-based valuation types. For public companies, there is more of a level 1 transparency of inputs. You're able to look at a market that hopefully is liquid, and pick out comparables where you can then say, look, are we looking at the EV to EBITDA? Are we adjusting for certain things? But in terms of a pool of benchmarks, there is more of a transparent pool for public companies. And maybe, just picking a last one as an example would be a technology firm. Now, for technology firms, you may see a very different rate of growth in the business prospects and the cash flows than you see in non-technology firms. And that's because the rate and the pace of growth and advancement, for instance, with a switching company, will be very different from a traditional retail company. And so the benchmark of value may differ very widely. We'll go into a bit more detail as my colleagues talk about the different methods of valuation. And as a last point, I wanted to just touch on factors that can affect value. So as we look at our valuation, a number of factors will affect value. I'll take one on this page, management experience. The way that you would value a company with a young, inexperienced management team might be very different from the way that you value a company with a strong, experienced management team who has led a similar business in a similar jurisdiction to profitability and is simply replicating that in a new business. There is already a lower level of risk that is attached to that. Therefore, this is a strong factor that may affect value. Another thing may be, financial performance is a given, but brand strength, for instance, may add quite a lot of value to the intangible aspects of a brand, of a company rather. So in valuing a company like Coca-Cola, the brand strength on its own would form a big part of the overall valuation versus a cola company that is generic and without a brand name. I hope that this entry has piqued our appetite, and I'm very confident that as we go into the detail and as my colleagues take us through, we will have the opportunity to expand on a number of these concepts and banter with a few questions and answers that will help us just navigate very clearly the concept of value and valuation. Thank you.
Thank you very much, Bimbola. That was insightful and about brand strength and how it will drive value. That's just but the beginning. Tejiri is ready to take us deep into the concept of business valuation. Over to you, Tejiri.
Yes, thank you, Tomiwa, and thank you, Abimbola, for setting the tone and for giving us that brief introduction on what business valuation entails. And good morning, everyone, once again, and thank you for joining, whether you're joining from your office, you're joining from your home, or even if you're on the move. Thank you for making the time to be part of this conversation on corporate valuation. So now, before we dive into this, I would say that this session is for everybody, whether you're deep into finance, if you're just starting your career, or you run a business, or you're just simply curious about how companies are valued, you are at the right place, and it has been designed with everyone in mind. So let's start with something simple and relatable. I would like to assume that some of us here have tried to sell something before, maybe your car, your phone, a piece of land, perhaps, and someone has asked you, how much are you going to sell this for? And you've had to pause and think that, what is this thing actually worth? So that question even gets more interesting when what you're selling is not a physical object, but a business. So let's bring it closer. If, for example, you're running a small bakery, or you just built an app, like as a tech person, and you have a few hundred users on the app already, and someone approaches you and says, I want to buy into your business, I want to invest in your business, how would you respond? What numbers will you quote to that person? And how can you defend that number with confidence? And that's the world of business valuation. As introduced earlier, my name is Tejiri, and I've had the opportunity to value a variety of businesses, from startups in their early stages to large companies preparing for financial reporting or for transactions. So what I'll be sharing with you today comes from, not only from professional experience, but also from practical lessons that have been learned along the way. So valuation may sound technical. Yes, it's technical because it involves numbers, it involves models, it involves assumptions. But at the core of it, it's about telling the story of a business through its value. And today, what we want to show you is how we can do that in the simplest and the most approachable way possible. So in this session, we'll be covering what business valuation is, why we do it, and the most common methods professionals use in estimating the values of the business. Okay, so I really want this session to be an engaging one. So please, as we go along, feel free to drop your questions and your thoughts or your reactions in the chat. There'll be time at the end of the session to go through them. I will try our best to answer them, to answer as many questions as we can. And by the time we're done, we expect you to walk away with some form of clarity and for you to understand not just what valuation is, but how to approach it and how to answer the right questions. So like I said, I want this to be an interactive session. So there's a poll question, or there's a question I'm going to be throwing out to the room now. So I'm just going to ask, why are you interested in this corporate valuation webinar today? So is it because you work in finance, or you manage a business, you are a student who is just learning the ropes, or you're considering investing in a business, or you're just simply curious about what valuation is about? So just drop your reactions or your responses in the chats, and I'll go through them just to see a mix of the audience we have today. So if you work in finance, you own a business, you're a student. So I can see the responses coming in already. Yeah, you're an investment banker, you're a student. Nice. Great. So it looks like we have a nice mix here. Some of you are working in finance, others are business owners, or some people are just curious learners, which is perfect because valuation touches everyone in some way. So let's start by answering the first and the most fundamental question: what exactly is business valuation, and why does it matter so much today? Next slide, please. So we have a quiz. Please, can we get the quiz question up? So just to test the understanding of our audience of what valuation is. So I don't know if you have access to the poll, the participants, but the question reads: what is the primary objective of a business valuation? Is it to calculate the book value using historical costs, to estimate the fair value of a business interest, to determine the liability from operational profits, or to set transfer pricing benchmarks for related party transactions? I can see the responses coming in already, and I think majority of you have gotten the question correct. Yes, the answer is B. So the primary objective of a business valuation is to estimate the fair value of a business interest. So I can see most of us are already on the same page with us. So that's a good start to this webinar. So next slide, please. So there are many misconceptions about valuation, and that's what we're going to try to clear out today. So we're going to let you know what valuation is not and what valuation is. So starting from what valuation is not. Valuation is not revenue. So what revenue is the total money a business earns from selling its product or from offering services. So usually it's called your top line or sales. But revenue is not valuation. So just because a business makes a lot of money does not mean that that business is valuable. What if the business has expenses that are higher than the revenue? What if its sales are not consistent? So valuation asks a bigger question. How much is this business really worth in terms of the value it can generate in future? So take, for instance, a business could be making 500 million naira in revenue, but spending 600 million naira in costs. It has high revenue, but it does not have value for the investors. So revenue is like your starting point, but valuation is about how much of that revenue turns into value. And also, after revenue and taking out the cost, what you have left is profit. So profit is what you have left after all expenses have been taken out from your revenue. So it just tells you if your business is making money. Profit is important, no doubt, but valuation looks deeper than that. Is that profit sustainable? Will that profit grow? What are the risks involved in the business? Two companies can have the same profits, but if one is operating in a risky industry and the other is in a more stable one, they are likely going to have different valuations. So a company can be making, or let's say there are two companies now, each of them making 100 million naira in profits. One is in tech, and everybody knows now that tech is a high growth potential industry, and the other one is in the declining industry. That tech firm will likely be valued much higher than the other firm or the other business that is operating in a declining industry. So in summary, profit shows performance, but valuation reflects the potential of that business. So profit just shows how that business is performing, but valuation shows what that business can do in future. Valuation is also not capital investment. So capital investment is the money you spend on your assets or items in your business, like your factories, your equipment, or let's say if you want to open new stores or new branches. So the money you spend in doing those things is what you call your capital investment or your capital expenditure. But this also is not valuation, because spending money does not automatically create value. What matters is what the investment returns to your shareholders. A business can spend billions of naira building new facilities, and they can still lose money if it does not generate profit from those assets that have been purchased. If, for instance, a business has invested 1 billion naira in machinery, but the demand for the product that business is offering drops, that means those machinery are going to be they're going to be idle, and that investment that the company or the business has made has not resulted into value to that business. So just because you've invested in a lot does not mean that your business is worth a lot. And like I said, capex or capital investment is what you use to get your assets. So valuation is not also assets. So assets are the things that the company owns, like your buildings, your machinery, or even brand names. Interesting that Abimbola also mentioned Coca-Cola. So Coca-Cola is the Coca-Cola name or the brand name is an asset to the Coca-Cola company. And usually mostly used when we're talking about assets or brand names that have good goodwill. But that also is not valuation. So having assets is good, but valuation looks at how those assets generate income. An asset-rich company can still be worthless if it's not making good returns or if those assets are outdated or underused. Like, for instance, a transport company or a logistics company can own trucks or vehicles, and if most of those vehicles are broken down or underused, they aren't adding much value to the business. So valuation is not about what you own, so your assets. It's not about that, but it's about what you do with what you own. Valuation is also not book value of equity. So the accounting equation, which says assets minus liabilities, gives you your equity. So your book value of equity is the difference between your company's assets and its liabilities. Basically, what's left for the owners according to the books. But book value, you should note that book value is based on historical cost and not market reality. It does not capture brand value. It does not capture customer loyalty or future growth. Another thing to also note about the book value of equity is that accounting methods can vary across jurisdictions. And let's say, for instance, a company has a particular machinery that it uses to generate or produce items for the company, and that asset may be fully depreciated on paper, but it's still generating income or still producing items for the company. So that does not mean that asset is not valuable, that asset is not generating value just because it has been fully depreciated of the book. That's why you have to be mindful when looking at the book value of equity, and it's also not valuation, as I stated earlier. Then also, valuation is not cash and cash equivalent. So what is cash? Cash is the money that the company has readily available. So like your bank balances or your short-term investments, or cash equivalents that the money market instrument can be easily converted into cash. So it has to be very liquid. But this also is not your valuation. You can have a lot of money in the bank, but you're not putting that money to use. So it's not generating value to the business. So cash is the piece of the puzzle, but it's not the whole picture. You need to look at the business itself. Can this business grow? Is this business profitable? A business holding 500 million naira in cash might still have no good strategy or good future prospect. So cash helps, but valuation measures the full engine. It measures everything as a whole, it's not just the fuel it's looking at. Now we've gotten an idea of what valuation is not. So it's not just about the numbers you see in your financial statements. It's what lies beneath those numbers. How will the business perform in future? What are the risks involved in this business? How attractive is this business to investors? So revenue, profit, assets, they are all good to have, but valuation is the big picture that connects all of them into one answer. What is this business truly worth? So now let's move on to what valuation is. Valuation is price. So price is the amount of money that is paid for a business or an asset in a transaction. So in simple terms or in understandable terms, it's just the agreed upon value between a buyer and a seller. And price is important because it's a direct reflection of what the market is willing to pay at any given moment. So when a business is sold or an asset is exchanged, the transaction price has already given you an immediate snapshot of what the perceived value of that asset or of that business or item is. But it's also important to note that price alone is not enough because price can be influenced by different factors that are outside the control of the actual performance of the business. So it can be affected by your market sentiment, it can be affected by urgency of the transaction, it can be affected by negotiation power as well. So a well-informed buyer or a seller that is driven by emotions may have that may have an impact on the price or of the price of the asset that is being sold. So price is just like a snapshot, what someone is willing to pay today. But however, the price does not always reflect the true value of the business or asset because external factors, like I said earlier, could influence the price. So valuation is also story and numbers. So valuation is a combination of storytelling and data. The story is about what the company does, how this company generates revenue, what market position it holds, and its strategic plans for the future. The numbers are the financial data, and so that has to do with your past performance, your projections, and other financial matters. So why is the story essential? The story is essential because it gives context to the numbers. Without understanding the business's strategy, the growth potential of the business, the market risk, the numbers will be meaningless. The numbers back up, and on the flip side of the coin, the numbers are backing up the story. So the numbers are ensuring that it's not just a hopeful narrative that is being sold, but also it's one that is based on solid financial performance and projections. The story is often about like the qualitative factors, like what the business stands for, why the business is competitive, and why it will succeed in the future. But on the other hand, where you have data, these are the hard points like your revenues, your profits, and your costs, which now helps translate those stories into reality. And it's like a weave. The story and the numbers must go hand in hand. Valuation is cash flow and discount rate. So valuation fundamentally revolves around understanding how much cash flow a business is expected to generate in future and discounting those cash flows to the present value using an appropriate discount rate. I know that may sound like a mouthful, but we'll talk about more about that going forward in subsequently in this session. But let me just give a brief overview of what cash flow and discount rate is. So cash flow is the amount of money the business is expected to generate after expenses and taxes have been deducted, but before you consider like your capex and your financing costs. Cash flow just reflects the ability of the business to generate money for its owners or for shareholders or for investors. Then the discount rate this represents the risk and the time value of money. Like I said, we'll talk about that much earlier, but let me just give an overview. So discount rate is what we use to discount those cash flows to present value. The further you go into the future, the cash flows are expected to be less valuable than they are today. So this discount rate helps to adjust for uncertainty and time. So valuation is basically based on the principle that a naira today is worth more than a naira tomorrow. So future cash flows must be discounted to reflect the fact that investors will need to take on risk in the future to receive those cash flows. A higher discount rate generally will lead to a lower valuation. Valuation involves knowledgeable and willing parties. So valuation assumes that all parties involved in the transaction, that's the buyer, the seller, and even if there's a third party, all of them are knowledgeable about the business. They have knowledge about the business, about the markets the business operates in, and all the risks involved. The buyer and the seller should be acting voluntarily and with reasonable expectations about the business, about what the business is worth. Why does this matter? It matters because if one party is uninformed or under duress, like being forced to sell due to maybe financial pressures or something, the resulting price may not reflect a fair valuation. So valuation assumes that the parties involved are operating on a level playing field with access to the same information and are negotiating in good faith, so to say. So valuation is not just about numbers and projections. It also depends on the understanding and behavior of the parties involved. If one party is uninformed or is under pressure, it can distort the transaction. It may lead to a price that does not affect or reflect the true value. So valuation, I'm sure we must have heard where people say that valuation is an art and a science combined, and that's true because it's based on price, but it's far more than just what someone is willing to pay. Valuation tells a story and relies on numbers to bring that story to life. It's built on future cash flows that a business is expected to generate, like I said, which is now adjusted to reflect risk and time that has passed. So this has given us an overview of what valuation is not and what valuation is. Next slide, please. So here we'll be talking about the standards of value, and we have 5 core standards of value. You have your market value, your investment value, your intrinsic value, your book value, and your fair value. So let's start with the market value. The market value is the estimated amount for which an asset should exchange between a willing buyer and a willing seller in an arm's length transaction. So that's after proper marketing has been done and those parties are willing and knowledgeable to make that transaction without being forced to do so. So, for example, if a property, a residential property is listed for sale, and after proper marketing and so on, a buyer and a seller have agreed on a price. That price reflects the market value. For instance, if similar homes in the area are selling for 100 million naira and this particular house is selling for 98 million naira, so that becomes a strong indicator of the market value of that property. Market value is commonly used in real estate appraisals, M&As, and for some regulatory assessments. It's like a benchmark in an open market transaction that reflects general market consensus or market agreements, not the specific preference of individual parties. Next, we have investment value. Investment value is the worth of an asset to a specific investor. So based on that investor's individual sentiments or requirements, risk profile or expectations. So for example, a strategic investor may decide to value a logistics company at, let's say, 1.2 billion naira just because of the expected synergies and strategic fits that they expect to get from that transaction, even if the general market may only value that business at 1 billion, but they will value it at 1.2 billion because they expect to get some synergies from that transaction. It's usually used in acquisitions, internal business planning, capital budgeting, and so on. So it just explains why different buyers might assign different values to the same assets just because of the strategic interest or maybe the financial outlook. So another standard of value to want to discuss is intrinsic value. Intrinsic value is the perceived value or the calculated true value of an asset based on its fundamental characteristics and the future earning potential. So this is a key thing when we are doing our DCF, so our discounted factor analysis. It talks about the intrinsic value. We will talk about that more later in the session. So for instance, an analyst might value a stock as 15 naira per share using the DCF analysis, even if the market is currently trading at 35, just because of temporary pessimism of that analyst. So this is usually used in equity research, investment analysis, and like I said, discounting factor, that's the income approach. We'll talk about that more during the course of the session. So it just helps you to identify undervalued and overvalued assets, and it helps in long-term investment decisions. Secondly, we have fair value. So fair value is in financial reporting, like under IFRS 13, can be defined as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So let's, for instance, the company owns unquoted equity, like equity investments, and they want to value them for financial reporting purposes. So what you need to do is to get the fair value of those assets using your level 1. So level 1, we have a fair value hierarchy, and level 1 has to do with your quoted prices in an active market. So when you're trying to get the fair value of those instruments, that's what we call a fair value of fair valuation of under financial reporting. So it's used for financial instruments, it's used for investment property, it's used for impairment testing. So this usually ensures transparency and comparability in financial statements across reporting entities. So we have some valuation procedures. So these are just basically steps when you want to carry out a valuation. And these are very crucial because if you don't know how or what to do when carrying out a valuation, you are likely not going to get the result that supports what you intended to do. So the first thing is to understand the business. So the very first step in the valuation process is getting a deep understanding of the business. And this goes way beyond just looking at the financials. It is about really understanding what the company does. How does this business make money? What industry does this business operate in? Who are the customers? Who are the competitors? Questions like that. So you're asking what makes this business basically. So for instance, if you're valuing a tech startup, it's completely different from when you're valuing a manufacturing company or when you're valuing a financial services firm. You need to understand the business model, whether it's subscription based, product based, or maybe it just depends on advertised revenue or something like that. Each model has its own risk profile and its own growth trajectory. It's also important to note that the company's strategic position is an important factor to take into consideration. So if the business, is that company a market leader? Are they disruptors, or are they just one of the many players in a highly competitive market? That will also drive the way you approach your valuation, how you understand the business. So in practice, this process, if you want to like be practical now, this process usually it involves going through like investor reports, pitch decks, or maybe having conversations with management. Because management, they are the owners of the business. They're the ones that will tell you what this business actually does. So it's not just about reading papers or reading the books or maybe reports. Having conversation with management is also very essential because you always get insight directly from the people who actually run the business. Then the next thing after understanding what the business does is to analyze the company's performance. So once you've gotten an understanding of what the business is, how the business operates, the next step is to analyze how well it's actually performing. So here we look at the financial statements, so your income statements, your balance sheet, cash flow statements. Ideally over like, let's say like if the business has been in existence for let's say like 10 years, you can get historical statements for maybe like the past 5 years just to see trends. But we're not just crunching the numbers for the sake of it. We are trying to identify patterns. Is revenue growing consistently? Is profit growing? Are margins expanding or shrinking? How does this performance compare to the company's peers? You also look at key ratios like your EV/EBITDA, your return on equity, asset turnover, etc. So, for instance, if you are valuing an equity stake, for instance, the return on equity can be insightful because it tells you how efficiently a business is using its capital to generate profits. So the next step is selecting the appropriate valuation method. So now you've understood the business, you've analyzed the company's performance and done all that. So now you have to choose the appropriate valuation method to carry out or to perform your valuation. There's no one size, there's no one size fits all approach here. The method you choose has to align with the nature of the business and the context of the valuation. But we have three broad categories, or three broad approaches for valuation. So you have the income approach, you have the market approach, and the cost approach. So I'm going to touch on them briefly, but we'll go more detailed later in the session. So for the income approach, this is typically done typically through a discounted cash flow analysis, and is usually used or is best used when you have predictable cash flows and you have enough information to forecast those cash flows. Like I mentioned earlier, that this is when we talk about intrinsic value. So the DCF captures the intrinsic value, and it's usually great for businesses that have strong visibility into the future, how business is going to perform in future. You also have the market approach. So market approach is where you have two branches of the market approach. You have the trading multiples and you have the precedent transactions. Like I said, we'll talk more about that further into the session. But the market approach is useful when you have a robust set of comparables. So like your comparable companies that are similar to the company that you want to value. So if, for instance, you want to value an FMCG, where investors rely heavily on market benchmarks, the market approach is the go-to approach to be used in that valuation. And lastly, we have the cost approach or your asset-based approach, which is usually more suitable for asset-heavy or early-stage businesses or distressed businesses. So this just involves you valuing the asset, getting the fair value of the asset, then subtracting the liabilities. So just essentially asking, what would it cost to rebuild this business? So the key here is to match the valuation method to the reality of the business. Oftentimes, we use more than one method just to corroborate or just to cross-check our results, just so that there's consistency. But it's ideal for you to know the actual methodology or the actual approach that applies to the valuation at that point in time. Then lastly, when you've carried out your valuation, the next thing now is to apply your conclusion. So you've arrived at a valuation or you've arrived at a range of values. You will now go back and recall what was the purpose of this valuation and how would this conclusion now be applied. So valuation is not done in isolation. It's always for a purpose. So it might be to support an investment decision. Maybe an investor is deciding to, maybe trying to decide whether a startup's price tag, maybe the value of a startup, just to justify if that price tag is justified. Or it could be to provide an independent opinion in an M&A deal or for financial reporting purposes under IFRS. The application also determines the level of detail and documentation that goes into that valuation report that you're going to offer. So for instance, if it's for internal decision making, the tone and the structure might be more flexible. But if it's for court proceedings or for like regulatory filings, that report needs to be more formal and well supported and defendable. And also at this point of where you're applying the valuation conclusion, you need to communicate your findings to the stakeholders. So that's the management, to investors, etc. So it says, which of the following is not considered the core valuation approach under the standard valuation frameworks? I can see our answers coming in already. So the answer to this question, like I see majority of us have chosen, is the option pricing method. The option pricing method. So like I mentioned earlier, we have the market approach, you have the cost approach and the income approach, but the option pricing method is not a core valuation approach under the standard valuation frameworks. So now we're talking about the premise of value. So premise of value, think of it as the underlying assumption about how a business will continue to operate. It's about the circumstances under which the assets are being. So you have the going concern value and you have the liquidation value. So these are the most common premises under valuation. So going concern value, let's talk about going concern value. It is usually useful in valuations for financial reporting, for M&A or for capital raise. So under the going concern premise, we assume that the business will continue to operate into the foreseeable future and to continue generating revenue and pursuing its strategic goals. So this means that we're valuing the business as an operating entity, not just as a bundle of assets. So we look at the company's or the business's ability to generate cash flows over time, ability for it to reinvest and to grow. So it's important to note that this premise assumes stability and continuity. So if a company is in distress or its future is uncertain, the assumption might not hold. And that's where the second premise of liquidation comes in. So on the flip side, liquidation value applies when a business is either expected to stop operating or has already stopped operating. So in this scenario, the focus now shifts from future earnings to what the individual assets can fetch when it is sold off. So either through an orderly sale or let's say in a more urgent situation, which is called the forced sale. So another liquidation is where the assets are sold off in a planned manner in order to maximize value. But a forced liquidation is where assets have to be sold off quickly, usually at a discount due to, let's say, financial pressure. And this is usually applied in cases like maybe bankruptcies, distress sales, and etc. And it's also important for collateral valuation purposes. So let's say when a lender wants to understand the value, they can recover when a borrower has defaulted. So just to sum up, the premise of value shapes the entire valuation approach. If the business is healthy, if the business is functioning properly, you are going to value that business as a going concern. So it's going to exist going into the future. But if that business is shutting down, the business is distressed, you're going to value the business based on the liquidation value premise. And that's where that premise comes relevant. So as valuers, you have to understand how, or the premise is your job for you to understand the facts on ground and to decide which premise fits the situation best. So we have the approaches to value. Like mentioned earlier, we have the income approach, the market approach, and the cost approach. So the income approach, let's start with the income approach, which is arguably the most theoretically sound method, especially for businesses that have predictable earnings and strong future prospects. So this approach is based on the idea that the value of a business is equal to the present value of its future economic benefits, usually in the form of, let's say, cash flows or earnings. And within the income approach, next slide, please. And within the income approach, we have, oh, sorry, there's a quiz question. Okay, let me just go back to this. So the income approach, there are three main subheadings or three main points under income approach. You have your DCF, you have your capitalized earnings method, and you have your dividend discount model. So under the DCF, so DCF is usually the go-to method for many analysts, especially in corporate finance. So with DCF, you can forecast the company's free cash flows over a number of years, typically like 5 to 10 years, and then you add the terminal value to capture the value beyond the forecast period. So those cash flows are then discounted back to the present value using a discount rate. So if it's free cash flows to the firm, you use a WACC. Your WACC is your weighted average cost of capital. Therefore, that will give you your enterprise value. But if you are valuing for equity shareholders, so your free cash flow to equity, you use your cost of equity as your discount rate to get the equity value of the investment. So the power of DCF lies in its ability to capture the intrinsic value of the business based on its own fundamentals. But that may also be a big challenge because, like I said, it's based on forecast. Forecast is based on assumptions because the output is only as good as the assumption. So forecasting revenue growth, margins, capex, etc. It all requires a solid understanding of what the business does and understanding of the market. So we also have the capitalized earnings method. So the capitalized earnings method is a simpler variation used when a company's earnings are expected to be stable into the future. So instead of projecting cash flows year by year, what you do is you take a single measure of like normalized earnings, let's say like your EBITDA or your net income, and then you divide this by cap rate or your capitalization rate. And this capitalization rate reflects the required return from that investment adjusted for growth and for risk. This capitalization rate method is useful for small businesses or mature companies that have steady cash flows, and it's usually quicker to do than the DCF, but is less suitable for high growth or cyclical companies when earnings can move or can swing from one place to the other. Then lastly, we have the dividend discount model. So the DDM is a more niche method, I'll say, but it's still part of the income approach, especially when you're valuing banks or mature companies that pay consistent dividend. So here, the idea is that the value of a company is simply the present value of all its future dividend. So instead of cash flows to the firm now, you are focusing on the returns to the shareholders. So it works best when the company has a stable dividend policy, but is not often used in practice for high growth or reinvestment heavy companies. So next slide, I think we should go to the next slide and let's just do the quick quiz. So the question says, why might two valuation analysts arrive at a materially different valuation for the same business? Is it because they've used financial projections under IFRS and another one used GAAP? Is it because they both have different assumptions such as growth rates, discount rates, comparable companies? Is it because of the business valuation standards, or is it because one used pre-money and the other one used post-money valuation? So majority of us have answered B, which is correct. So different assumptions such as your growth rates and discount rates and comparable company selection can affect the outcomes of two different valuation analysts. Next slide, please. So I've discussed the DCF, the capitalized earnings, and the dividend discount model. So this slide says that we have an example here, a scenario that says CMSG Limited operates within the consumer sector and has approached a professional service firm to carry out a business valuation for capital raising purposes. CMSG had provided historical financial statements for the past 5 years and has also provided a 5-year projection of the company. In performing the business valuation of this company, like I said earlier, when you have the forecast that will be provided by management, ideally the first thing to do or the first thing to consider is the income approach. So under this scenario, the income approach would be the best approach to use and maybe corroborate it with the market approach. So I'll hand over now to Suleiman to take us through the computation under the income approach.
Thanks, Tejiri, for the insights that you've provided, and thank you very much, Bimbola, as well for the wonderful introduction. So my name is Suleiman Ishola. I do valuations and modeling at Deloitte, and I'm excited to be here. Interestingly, while I was thinking about this session yesterday, so I asked ChatGPT, and I said, look, I have a webinar to discuss valuation tomorrow. Can you tell me the best form of introduction? And I'm just going to read out what GPT said. So it says, valuing a business is like solving a puzzle, right? You need to consider various pieces. And then I asked, what are the pieces? What are the things we need to consider?
It mentioned financials. It mentioned market trends. Management is another. And it says, and much more to estimate its true worth. So I'll quickly mention them again. The first one is a financial statement, the financials, the numbers. The second thing he mentioned is the trends in the market. The third is management, and it says much more. So I asked again, look, this is too brief. Can you make it encompassing? Then it says valuing a business is an art and a science of uncovering a company's true worth by weaving together financial data, market insights, and strategic vision of management. So what am I trying to achieve? When you are valuing a business, it's beyond the numbers you have in front of you. It's beyond the historical performance of the business. It's beyond what you've been told by management. Over and beyond that, what's the industry the company plays? Are they growing, or has that industry sort of saturated, right? Is there gap? Is there a market gap, and is there a gap in the market? That has to be answered. You need to assess the risk in the entity and what's the vision of that business. I mean, we all know at one point in time, Nokia was a phone that was with all of us, right? Just imagine someone valuing Nokia 20 years ago at its prime is going to put some significant value into it, right? But looking back, right, you would then say, oh, at that point in time, is the trend in the markets supporting the value? Is management's vision driving the value? So all of those needs to be answered. But again, if we look at the income approach, now I'm going to give some practical insights. For you, or before you consider adopting the income approach, one key thing you need to answer is the company, is the asset income generating? So if it's not an income, and Tomo, if you can go to the next slide, that would be helpful. Is the asset generating income? And is it expected to sustainably generate that income into the future? So that's very key. Now, if you've been able to answer the questions, you've assessed the market trends, you've been able to answer that the company can comfortably generate the revenue and the cash flows into the future, you've been able to confirm that the industry can support, the growth rate in the industry can support what management is projecting. Then the question you need to ask yourself is, so what's my cash flow, or what's the cash flow that will be distributable to the providers of capital, right? And look, as Tejiri mentioned, there are different types of income approach. What was critical that I need everybody to understand is that your definition of income approach is driven by the nature of the cash flows you are using. So if you've decided to look at the cash flows that belongs to all providers of capital, both debts, both preference shareholders, both equity shareholders, all of them, then you will then say you're looking at it from the free cash flow to the firm concept. And when we say free cash flow to the firm, it's simply cash flows that is free and available for distribution. And when you look at it from the top line, as Tejiri mentioned, revenue is not value, that because the revenue is not free, you need to take care of all the costs and all the expenses that need to come out. And then you derive your EBIT, that's the earnings before interest and tax. And you ask yourself, is this free? It is not, because you need to pay your taxes. So you back the taxes out. After you've done that, remember, depreciation is not a cash item. It's really an accounting item. So because you've deducted it in deriving your EBIT, you had it back. Then the business needs to make reinvestments into expansion. Because when you were doing your cash flows, you've analyzed the vision of the business, you've assessed the performance of the business, and you are saying this business has the capacity to grow because the industry can grow. However, there is a limitation in terms of the capacity of the plant, right? What that means is, to support the growth, the business needs to put some investments in capital expenditure to support the expansion. So you need to back out the capex, right? The next thing is businesses need to make investments in their working capital because they need to run this. They need to do a day-to-day running of the business, and they need to put in some cash to cater for it. So you need to also cater for that investment required in net working capital to expand. When you remove that, then you have your free cash flow to the firm. So this free cash flow is indeed the cash flow that all providers of capital can come to share from, and you can use this to derive your value. Now, when you get this, again, remember what Tejiri mentioned earlier. There is risk in the future. So we've estimated all of these cash flows into the future. However, 1 naira today is not 1 naira tomorrow. Why? Because of the concept of time value of money. Now, to account for that risk, we need to discount those future cash flows back to today. And that's where the discounting comes in. We'll get into that very shortly. However, what I need to mention to you is that in doing the discounting, you must ensure that you compare apples for apples. Remember, the cash flows we are looking at here is a free cash flows available to the firm. What that means is that whatever risk you are capturing has to reflect the risk of all providers of capital. And that's why the definition of the discount rate you will then use is the cost of capital, is the weighted average cost of capital, where you are going to weight the cost of getting each sources of capital and then apply that as a discount rate. Another thing I would like to mention, which we always see as issues when we do valuation or we have to review valuation, is the discounting or the discounting assumption. Should you be doing a midpoint discounting convention or year-end discounting convention? Should you be doing 1, 2, 3, 4, 5 or have 0.5, 1.5? We always see this. What should drive your discounting convention is the nature of the cash flows. If it's a business that generates cash flows evenly throughout the year, then you have to consider doing a midpoint discounting convention where you assume that the cash flows will accrue to the entity over the years, and then you then do 0.5. When you are doing your discount, rather than saying 1/1 plus r raised to power n, your n will then be 0.5, 1.5, and all of that. However, if it's a contractual cash flows, especially when you are valuing debts, where the cash flows will only come in at the end of a period, then it won't be appropriate to use the midpoint discounting convention. What you consider applying then is the end of period discounting convention. So you can comfortably say it's 1/1 plus r raised to power 1, 2, 3, and 4. Now, when you do the discounting, it's important to also note that when you value using the free cash flow to firm, what you derive is the enterprise value, the enterprise value of the business. And usually, you must adjust for net debt because you're trying to derive the equity value. You need to assess the level of debt in the business and back it out. If we remember, the capital structure of a business is debt and equity. So if you've obtained the value of the entire firm, which is both debt and equity, in deriving the value of equity, then you back out any debt in the business and you had any excess cash that sits in the business. Also, it will be important to mention that when you do your forecasting over a discrete period, right? You've done the forecasting and it's over a finite period. Businesses usually, and again, if we go back to the premise of valuation, as Tejiri discussed, it's either it's on a going concern assumption or on a liquidation basis, right? If it's a going concern, what does that mean? It means that business will exist into perpetuity. It's going to exist for 100, 200 years and the likes. The question is, will you then do a projection over 200 years? Or will you do a projection over 100 years? No. The easy way and the way valuation professionals have done is, look, what you need to do is to project over a finite period. So We do a projection over 5 years or over a period until the business reaches stability. So once the business reaches stability, then you assume that the business can continue to grow at a stable at a stable growth rate into the future. So what that means is we need to come up with what we call terminal value. Now, in deriving the terminal value, there are two ways that you can come up with it, and that's where we've put one. You can either use your Gordon's growth model or you use the private equity exit multiples. So what Gordon's growth model is saying is that from here into the future, how or what's the value of that business, right? And then the exit multiples is which is usually used by private equity investors. It's saying, let's assume I'm exiting this business. At exit, how much multiples of EBITDA can I exit and sell off the business? And then you can use that as the cash flow the business will generate into perpetuity. So that's the definition of the free cash flow to firm. And next slide, if you go to the next slide, is largely speaking to the cash flow to equity. The major difference is, remember, just a slide before here, we're talking about the cash flows available to all providers of capital, right? Here, we are talking about the cash flow available to only the equity holders. What that means is, after you've gotten your free cash flow to firm, then the question is, what are the things that won't belong to equity holders? The answer is simple. It's really the expectation of the debt investors. A debt investor will expect him to pay him off his interest, and that's why you would then see that we are backing out the interest expense, right? Just below the net working capital. The next question is, a debt investor is expected to redeem his balance at some point in time. So you need to back out the repayments or the net borrowings of the debt investor. When you back all of these out, then you have the free cash flow that is available to the equity holders. This cash flow is distributable to equity holders as dividends. Now, you can discount these back to today to derive the value. The question is, what is the definition of the discount rate? Remember, as I mentioned earlier, it has to be apples for apples. So you are discounting cash flows to the firm at WACC because it all belongs to the providers of capital, right? Now you've back out debt, meaning you're only looking at cash flows belonging to equity holders. In that case, the discount rate has to be the cost of equity, which again we'll get into. Now, it's worthy to mention that when you conduct valuation using the income approach, the value you derive at, because you're looking at it on the 100% basis. You are saying, look, whoever buys this company has the ability to direct the activities of the business, has the ability to decide the timing and quantum of dividend payments, right? It means you are valuing it on a controlling basis, right? And if it's a private company, remember, all the assumptions that goes into the discount rates, which we'll get into, assumes that the company is also is liquid, right? Which is not the case for a private company. What I'm saying is when you do this, you realize that your business that you valued is on a controlling and marketable basis. Hence, if it's a minority, if it's a minority stake you are valuing, you need to account for the fact that minority shareholders don't have access to decision making. They are receivers of decision. Hence, when they are considering buying, they will ask for some discounts. I mean, it's normal. You then say, look, I am not going to be the one making decisions to when you pay dividend and how much dividends you pay, right? Then I demand some discounts. So when you do this, it means the value will then be on a non-controlling basis. And also, if it's a private company you are valuing that is not traded on any primary or secondary exchange, then you also need to adjust for the discount for lack of marketability, because should there be a reason to sell your stake in that business, it's going to take time. You're going to have to engage an investment banker. You're going to have to go through the whole auction process to get a buyer, which means there will be some delay in getting liquidity when you need to go out. Hence, you need to adjust for a discount for lack of marketability or lack of liquidity, or what some people will call illiquidity discount. When we get to the valuation masterclass, of course, we'll get into all of these analysis and how we usually derive the rates that are applicable for each of the calculation. Tomiwa, is there something else? Yeah, so I'll hand over back to my colleague to continue with the market approach. Thank you.
Thank you very much, Suleiman, for giving us an explanation and insight into the free cash flow to the firm and the free cash flow to equity, like you mentioned. For the free cash flow to the firm, when you're discounting, you use the WACC, and for the free cash flow to equity, when you're discounting, you use the cost of equity. So now let's move on to the market approach. So market approach is based on the idea that the value of a business can be inferred from comparable companies or from transactions, similar transactions in the market. So this approach is usually used in investment banking, PE, or let's say corporate transactions, because it reflects how similar businesses are being priced in the real world. So like I mentioned earlier during the course of the session, we have two methods under the market approach. You have the guideline public company method and you have the precedent transaction. Under the guideline public company method, here you look at listed companies that are similar to that business that you are going to value. So in terms of size, in terms of the industry it operates in, and also in terms of, let's say, geography and its operations, you now extract the valuation multiples from these companies, from these comparable companies, like say maybe your EV/EBITDA, your price to earnings, your EV sales, and then you now apply those multiples to the target's own financial metrics. So let's say, for example, if a similar company to the one you're about to value is trading at 8 times EBITDA, and the target has an EBITDA of 10 million naira. So what you do, you apply that 8x on the EBITDA of the company you're about to value, which gives an implied value of 80 million naira for the business you are about to value, an enterprise value of 80 million naira. So this method is transparent because you can see the market data out there, you can see the multiples of these companies out there, and it's based on live market data, but it comes with some challenges because some public companies are often much larger and maybe more diversified than the one you're valuing. So you have to make some careful adjustments and judgments, in which Suleiman will also take and further on in this session. Then the next thing we have is the precedent transaction method, also known as your M&A comps or your guideline transaction method. So this method actually looks at transactions that have actually happened. You're looking at actual transaction data from previous acquisitions of similar companies, and you're now extracting the multiples paid from those transactions onto your own valuation. And this can be insightful because it reflects what buyers were actually willing to pay, including the control premium. So it reflects what buyers actually paid for that business. So that's why it becomes useful when you're valuing your business. But just like with public companies transaction or public companies and valuation, no two transactions are exactly the same because each deal might be influenced by factors like, let's say, synergies, buyer motivations, market timing, etc. And also because transaction data may not be frequently available or readily available, especially in emerging markets. So this method, transactions methods, works best when you have access to reliable databases or deal information. So if you go to the next slide has an illustration. So it says Zenova Holdings operates within the financial technology sector and has approached a professional services firm to carry out a fairness opinion for a subsidiary it intends to dispose. Zenova has provided both historical and projected financial statements. So in performing the business valuation, we'll primarily consider two methods. So you consider the market approach, which is the guideline companies method and guideline transaction method. So why are we going to consider this approach? Because you have availability of the historical statement. You can see the historical statement, but what you're going to be applying your multiple on is the historical EBITDA. So the EBITDA as at the valuation date, not like your future EBITDA, not your prospective EBITDA. The EBITDA at the valuation date, you're going to be applying the valuation to. So when you have historical statements available, it's ideal to use your market approach. And the market approach also reflects current market conditions and the prices that similar assets are being sold. Like I explained earlier, the transaction method, what businesses actually paid for. So you can just use that on your own evaluation to get an idea of what the value of the business is. We did not consider the income approach as the future of the business will no longer depend on Zenova, and because of the acquirer's strategic vision. Like I mentioned earlier, the business is being sold to another handler. So even if, let's say, Zenova has already projected some things that it's going to do in future, they're not going to be relevant anymore because the business is being sold to someone else. So the income approach will not be relevant under this situation. And if you go into the next slide, there's an illustration where Suleiman will be taking us through as well. Thank you.
Yeah, Thanks very much, Tejri. So again, we've discussed market approach, and we understand the principle in which it hinges on. You want to acquire an asset, and you're wondering how much to pay. However, you understand your friend has recently bought a similar asset in the past. That's a good basis. You want to buy an asset that is not traded on any exchange, and you understand that there is a similar asset which is traded fully on an exchange. That can be a basis for you to buy. So what I'm trying to say is the market approach hinges on the law of one price, which means that similar assets should sell for similar prices, whether it's a recent transaction or in a public market. And that's why usually when we talk about market approach, there are two types. It can either be comparable companies, where your reliance is really on an exchange, on a liquid exchange, or comparable transactions, where your reliance is really on recent transactions in which shares in the company or in comparable companies have been bought or sold. For instance, you're considering buying a bank in Nigeria. You're wondering how much to pay. The bank you are valuing or that you want to buy is not quoted. However, you remember that 3 years ago, 4 years ago, or 5 years ago, an Access Bank acquired a Diamond Bank. Then you can look at the basis in which they were bought. But people always say, look, when you say I should use comparable companies, how do I determine the metrics to apply? Usually, it's driven by the industry you are trying to buy. For instance, let's assume you are valuing a refinery, and the refinery you are valuing or that you are considering buying has 100,000 barrels capacity. Now, you have another refinery that is quoted on an exchange where you know the value. You can quickly look at the value per the barrels of oil capacity, and that's a good metrics, right? If it's telecoms, and you're considering valuing a business in the telecom industry, and you are wondering, okay, I know the value of this telecom in the stock exchange, then what's the metric? You can see, okay, what's the number of subscribers of that telecom? They can get the value per subscriber and apply it on the number of subscriber of the company you are valuing, right? For, say, a business in the payment space or the fintechs and all of that, you're wondering, there's a business you're valuing that you know has processed X amount of transaction value, and you're wondering, you have one that has recently raised funding. Then the question is, what is the value per the transaction volume they've processed? The same thing goes for hotel, where you are saying, look, based on the number of available rooms, the value per rooms, they can quickly do the analysis. However, on a general metrics, we say, let's relate the value to a metric in the financials. And people say, oh, there are different metrics. The first one I need to mention is, we'll try to say it can be value to revenue. So you can say the enterprise value to revenue, right? However, because of the limitations that Tejri mentioned around revenue and how revenue is not a good assessment of value of a business, right? Then we then move to another measurement, which is what we call EBITDA. So EBITDA for a business is the closest to cash on the company's financials, right? Then you see people or valuation professionals saying we then look at enterprise value to EBITDA, right? However, for businesses in the financial institutions, the financial services, because of the challenges of how you classify the debts, will you classify the debt as equity, or is there even any, or I mean, will you classify the debt rather as financing or operating? Because you borrow to lend to your customers. So usually we pack out the entire concept of debt in valuing banks, and then we'll focus on the equity. And that's why we use equity value multiples when you are valuing back. And the best metrics to relate your equity to in the financial statement, in the income statement, is the earnings, because the earnings belongs to the equity holders. And that's why you would then see the price to earnings, or in some instances, the price to book. So that sort of gives you the insight as to the kind of multiples that we apply when we are valuing businesses, depending on the industry in which they operate, or depending on how their balance sheet stacks up, right? However, in our markets, we are in emerging markets where data is a problem. We know the limitations around getting data, especially when you are valuing businesses and you realize that the comparable companies are also private companies. Now, what we do is then to extend our search to markets, to more developed markets or other sub-Saharan African markets, right? However, I mean, I'm sure a lot of us are wondering, look, Suleiman, you want us to value a business in Nigeria using metrics of companies outside of Nigeria. Then the question of the risk that you are trying to avoid is a country risk, because you're wondering, businesses in Nigeria with this high or heightened country risk should not be comparable to businesses in a more developed market with lesser risk. Then we then make adjustments to account for the country risk premium. Again, there's a proprietary analysis that we do that will eventually get into when we get into the masterclass in September, or if you decide to come for the masterclass. The second one is the size risk, where we then say, look, companies in Nigeria or companies in this part of the world might be smaller relative to companies in the more developed markets, right? And then the next thing we then do is to account for the size risk, right? And those are the adjustments that you've seen us make. So when we do that adjustment, because you don't rely on a company and say that's your comparable, right? You need to assess several comparables. And remember what Tejiri mentioned earlier at the beginning of the class. The first thing you actually need to do when you are conducting valuation is understanding the business. So your understanding of the business must have guided you in deriving all of these peers to say these are the peers that you need to consider, right? So after that, you get your you use your statistical analysis, your mean, median, and if there are some outliers, then you consider using something to remove the outliers, maybe an harmonic mean or something, and then you get the true. Then this example is using price to book, right? So we have the price to book of the peers. Then you apply the book value. So remember, it's price over book. What you are trying to derive is the price, is the share price, is the value of the shares, right? Meaning, to get the share price, you then need to multiply the book value of the target of the company you are valuing. So when you do that, you derive your equity value on a non-controlling and marketable basis. Why? Because the shares of these businesses are quoted on an exchange on a per unit basis. So when you use this approach, the natural thing is going to give you is a value on a non-controlling basis. So if you are valuing a controlling stake, then you need to account for a control premium, right? Also, remember, these comparables are quoted. They are listed on an exchange. If the business you are valuing is a private company, you also need to account for discounts for lack of marketability, as I've explained earlier. So that's really it. That's how we stack up the calculations of a market approach. Thank you. So over to you again, Tejiri.
Thank you very much, Suleiman, for that insight into the computation of the market approach. So moving on, because of our time, we'll go into the assets or cost approach. So I mentioned this earlier that this cost approach is particularly used when you are valuing asset-heavy companies or early-stage businesses that have little revenue, or even for distressed entities. So this method usually asks, what would it cost to recreate or replace this business today, or this asset today? Or what are the net assets worth if the company were to shut down or to be sold off today? And under this, we have two main methods. You have the net assets value method and you have the replacement cost method. under the net asset value method, so this is a balance sheet focused approach. So you take the total value of the company's assets and adjust fair value, and you subtract all its liabilities. So this type of valuation works best with entities where they have their assets that are fairly liquid, and it's easy to establish the valuation of these assets. But however, you should note that it does not capture the earning potential or the earning power of or the intangible assets or intangible values of the business, like your brand equity, your customer relationships, etc. So it's not usually suitable for operating businesses that have significant potential or significant goodwill. So that's under your net assets valuation method. So you're just basically taking out your fair value of your liabilities from the fair value of your assets to get the value of the business. Then the next thing we have is the replacement cost method. So this method, you consider what it will cost to build the same assets. So that asset you are trying to value, how much will it cost to build that assets from the scratch? So that's same equipment, same assets, same capabilities, etc. And it's mostly used for infrastructure heavy businesses. Let's say like for power holding businesses now, because they have a lot of assets, infrastructure assets, is preferable to use the cost approach, replacement cost approach for value businesses like that. But another thing to note that it also provides a floor value in litigation scenarios or for distress scenarios. Just know the amount of value that will be attributable to the party that is in distress. So again, it does not reflect profitability or strategic value because it's not showing what can happen in the future. It's just showing like a balance sheet approach, but it gives a sense of the investment needed to replicate or to replace the business. So to wrap it up, I don't know if Sulaiman wants to take us through the computation under the asset-based approach before I wrap up. And okay, there's another example as well. Okay, Axiom Automotives produces automotive parts and has a variety of physical assets, including machinery, inventory, and land. The company has been struggling with declining profits and is considering a strategic sale. A potential buyer is interested in valuing the company based on its assets. So like I explained earlier, when companies are in distress, the go-to or the first thing that comes to your mind, since the business is not a going concern, is to use the net asset valuation approach. So here we are going to consider the book value method within the asset-based approach because Axiom is an asset-intensive company, and another reason is that the company is in distress. So handing over to Sulaiman to take us through. Thank you.
Yeah, thanks, Tejri. I'm sure a lot of our participants will be wondering, so why are we talking about asset base since we are considering valuation? It's interesting that in some instances, this approach will be the best. So I recall about a year or two where a business was in receivership, and the court mandated that they value the assets. Value the business. When they went on receivership, they've closed down the store, they've closed down the business, and nothing was operating. So the question is, what approach? We use the DCF because you're not even sure when and if they will start operation. The next thing we needed to do was to apply the net asset method. Then the question is, I'm sure a lot of people are wondering again, Suleiman, why not just pick up the balance sheet and then the net asset is it? Well, indeed, that might not be the best value. Why? Because after we got into the business, we realized that the business has been under lock for about 6 months. Majority of the inventory were already obsolete. It means you need to make some adjustments on the balance sheet. When we went into, we realized that some receivables have been collected. Some are bad, right? So we needed to make the adjustment to reflect what is receivable, right? And of course, you do similar thing for liabilities. What you indeed need to watch out for are accounting provisions that will not result in you paying anybody, right? It's just an accounting provision. So you need to exclude it because indeed you don't need to pay anyone. Another thing you need to always note is the deferred tax asset. You know, when a business is closing down, you won't go and you won't go to the taxman and say, look, I have these tax assets that, yes, if I will be in operation, I will utilize it, but because I'm closing down, can you please pay me? That is not going to happen, So that needs to be excluded. So indeed, you look at the balance sheet and discretely make adjustments to see what is collectible or what is realizable. And then you use that to derive your net asset, and then that can be seen to be the value of the assets. Also, the depreciation replacement cost method is a method that we usually use for valuing intangible assets. I won't go into it. I think during the masterclass, for those that will enroll and join us eventually, we'll speak shortly around how to value intangible assets. And a lot of us are wondering, there are intangible asset, there is brand, there is, how do you guys value it? Do you even value it? Do you even value goodwill? How do you guys derive it? Yes, we do, and there are methods to do that. So, yeah, I'll pause and hand over back to Tejri and Tomiwa.
Okay, thank you very much, Suleiman, for that insight. So we have the final quiz for this session. So if you can go to the next slide, or you can put up the poll questions. So it says, in a DCF valuation, the weighted average cost of capital is typically used to A, adjust net income for inflation, capitalize the terminal value into perpetuity, reflect the time value of money and the risk in discounting the free cash flows, and estimate current market capitalization. So let's see your responses, please. C, majority of us are saying C. That means we've done a good job today, and we all were paying attention to the class. So yes, the answer is C. It's used to reflect the time value of money and the risk in discounting the cash flow. So well done, and well done to everyone who has responded. You all got the answers correct. So just to wrap it up, we've spoken about, Suleiman has given us insights into the free cash flow to equity. He has spoken about the free cash flow to firm, and he has also touched on the discount rates, and where he says you have to do likes for likes. So if you are discounting your free cash flow to equity, you use your cost of equity. If you are discounting your free cash flow to the firm, you use your WACC, which is the combination of your equity and your debt. So the cost attributable to equity holders and the cost attributable to the debt holders. So I'm just going to touch on the risk premium and beta, because we've not really spoken about that yet. So risk premium. So let's just get a bit and talk about risk premium. So this is one of the most important ideas behind the discount rate. So it basically answers the question, if I'm investing in this business, how much extra return should I expect from taking on more risk than a risk-free asset? So when you talk about risk-free assets, I'm talking about maybe your treasury bills, government bonds, etc. So for example, if the risk-free rate is 4% and I expect a return of 10% from investing in a company, so then the equity risk premium from that investment is your 10% less your 4%. So your equity risk premium is going to be 6%. But risk premium isn't just market based, because you may also decide to include a size premium. Like Suleiman mentioned, there's some other adjustment that you make. So for some small companies that are riskier, you may introduce a size premium, or you can also introduce a country risk premium. So like there's some countries that have that are more volatile or more prone to, let's say, wars or things like that. So those countries, when you have such countries in your comparables, you have to adjust for a country risk premium or for emerging markets. So the key idea is that the higher the perceived risk, the higher the return for the investors. So investors also want to demand a higher return when they perceive a higher risk, and therefore that will lead to a higher discount rate. So now let's move on to beta. So beta ties directly to your risk premium. So beta is a measure of risk. So it measures how volatile or sensitive a company's returns are compared to the overall market. A beta of 1 indicates that the company is moving in line with the market. A beta of more than 1 shows that a company is more volatile than the market. So let's say, for instance, if the market goes up by 10% and your company has a beta of 1.5, it means that your company is expected to go up by 15%. But the same applies on the flip side. So if your company, the market is 1 and yours is 0.8, so that means it could drop faster. So beta is used in your capital asset pricing model. We'll talk more about this in the masterclass, and maybe you just touch on it in the next slide. So the CAPM is the backbone or the driver behind the cost of equity computation. So it's basically your risk-free rate plus your beta multiplied by the market risk premium. So beta can be estimated using regression analysis, but that's like using the long route. So what we usually do is we go to databases like your Capital IQ, S&P Capital IQ, or your Bloomberg to get the beta of the industry that your target is operating in. And if the company isn't listed, so there's something they call the unlevering and relevering of beta, which will be touched more during the masterclass, just for you to get a realistic estimate. But what makes beta very useful, especially when you're doing equity valuation, because it encompasses your business risk and your financial risk. So just touching a bit also on the discount rate, all these elements flow into the discount rate. So your risk-free rate, your ERP, your beta, they all flow into the discount rate, and they're all there for a reason. So first of all, your risk-free rate, it sets a base level of return. So if at all nothing, you don't get any other return, you should at least get the minimum, which is your risk-free rate, the return on your risk-free rate. So that is where the risk-free rate comes in. Then you have the equity risk premium, which accounts for market volatility. Then you have your beta, which adjusts for company-specific volatility. And if it's a case where you're using WACC, that's when you now bring your cost of debt, which reflects how much the company will pay on its borrowings, but adjusted for tax. It's for tax, I beg your pardon. So it's said that the higher the risk, the higher the discount rate, and the lower the valuation. So it's crucial for you to estimate your discount rate appropriately, because if your discount rate is not correct, it can either break your valuation. So summarizing it all up, FCFE and FCFF tells you how much cash is being generated, either to equity holders or to capital providers. Risk premium, on the other hand, and beta help us to understand how much risk. So they are just like measures of risk to measure how much risk you are taking and how much return you're expecting to get for taking on those risks. And the discount rate is how you now translate all those future cash flows back to present value. So I'm just going to stop here or pause here and hand over to Sulaiman to take us through the remaining slides. Thank you.
Yeah, thank you very much, Tejri. So, and I've seen a lot of people ask questions around how do you come up with the discount rate or the cost of capital. And I want us to, I mean, when if you think about it properly, when you are investing in a company and you want to assess your return expectation, it's not hard to figure out. Your return expectation is really your opportunity cost of that investment. To say, if I decide to invest in this private company, my opportunity cost of that investment is the return I would have earned elsewhere. And I want us to understand that as a concept of discount rates. Now, having that at the back of our mind, then the question is, how do you then assess your opportunity costs, right? The first one is the amount you would have invested, right? If you decide to invest in the equity of other company. So let's build it up. And in deriving that, if you want to invest in a business equity or in a business equity, your return expectation is, you can decide to invest in a risk-free asset, in a risk-free bond. That is, rather than investing in any risky asset or in any equity, let me rather invest in the government bond. Government bond is seen to be risky. So if you decide to then invest in a government bond, but you're not investing in a government bond, you are investing in a risky asset, it then means for you to get to the return you are expecting, you need to get some return over and above the risk-free rate. So if the risk-free rate is paying 17.2%, then to answer some of the questions, the risk-free is usually I've mentioned that is a government bond, so you need to get the yield on a government bond, liquid government bond on the wrong government bond that has similar tenor as the business you are valuing. Usually, we then just pick the longest maturing government bond. Again, remember, it has to be liquid, so you are sure that is reflecting the value. Now, over and above that, then you need to account for all other premiums. To start with, the next is the equity risk premium. The equity risk premium is the premium that investors have derived in the past over risk-free because they invested in the equity market. So the way this is usually derived is to say, in the last 20 years or in the last 50 years, what is the risk-free in the market and what is the equity market return in the market? The differential is the equity risk premium. And that is the premium you would demand over and above risk-free. When you had those two together, right, of course, you adjust for the beta because of the sensitivities due to the industry. Because in some industry that are more riskier, you would demand more premium. For industries that are less riskier, you would demand less premium. And that's what beta is actually doing, right? When you had the two together, that gives you a sizable return, right? However, when you now look at the company you could otherwise have invested in relative to the company you've decided to invest in, it is a smaller company. You are investing in a smaller company because of that size, that smaller size. You then talk to your to the person you are investing in and say, look, because this company is smaller, I need an extra return to compensate me for the risk of investing in a smaller business. And that's what the size risk is doing, right? And then if you realize that there are other risks in the business, maybe it's a one-man business and the guy can decide he's crossing road one day and then something happens to him and he's gone. And your investment is gone. You account for that risk in that investment. If that business you realize that is really a monoproduct company, the only thing that they sell is one, right? And it means anything that happens to that product, the business is gone. You account for that as well. So you use this to account for all risk you are seeing in the business. So over and beyond the equity risk premium, you can also capture what we'll call the size risk and the firm specific risk, right? And when you add all of that together, you get your cost of debt. And then you look at the cost of equity. When you have the cost of equity and the cost of debt, then to you have your discount rate. However, remember, you need to ask yourself, what cash flows am I discounting? Is it an equity cash flow or a debt cash flow? Or a cash flow that belongs to the two of them? So if it's an equity cash flow, you discount using cost of equity. If it's a debt cash flow, in case you are valuing debt instruments, you use cost of debt. But if that cash flow belongs to both equity holders and debt holders, then you need to use a cost that reflects the two. And that's where the concept of weighted average cost of capital comes in. So you look at your capital structure. What is the contribution of debt in that capital structure? If it's 10%, then that means your cost of debt should only contribute 10% to the overall weight. You look at your cost of equity, your equity relative to your capital structure. If it's 90%, then you apply 90%. However, it's worthy to note that we usually don't look at the book value of cap structure because that might not be the optimal, especially when you are doing fair valuation where you are looking at it from the market participant perspective. If a market participant will not finance the business the way you are financing, it means you are leaving money on the table. And if it's a fair valuation you are doing, you have to look at it from a market participant perspective. And that's why usually the cap structure you are adopting has to be the optimal cap structure or the peers cap structure, because overall, peer companies are expected to adopt what we consider to be the optimal cap structure. And that's really how we derive the cost of capital. Some things I want you to note is that please ensure that the currency of your cash flows is also the currency of your discount rate. So don't value a dollar denominated cash flows using a naira discount rate. There is a mismatch, right? You also need to understand whether your cash flows are real or nominal, because when you understand this, you need to ensure that your discount rate is also matching that. So if it's a nominal cash flows, you ensure you are discounting using the nominal discount rate. And if it's a real cash flows, then you have to discount using the real discount rate. Yeah, thank you. Next slide. And the next slide is really a lot of people will be wondering, and I'll not spend a lot of time here, is when people say, look, I'm valuing a startup, is a business that hasn't even started operation. If you ask me to value Dangote Cement now, I will jump and say, yeah, it's easy because it's a business that has history. But when a guy comes in front of you and all he's presenting to you to invest in is a PowerPoint, that becomes more dicey and difficult. And you're asking yourself, how do I value this entity. These are more some of the conversations we'll have when we have the mastercard the masterclass rather in September. And if you go to the next slide, so to put it together, valuation is an art and a science. In fact, it's more of an art because there are AI tools, there are templates, there are tools I've put together even within Deloitte that can easily help in valuing businesses. But what's really critical is that you understand the business and you put experience together in valuing. So it's more of an art than a science, right? And you need to understand the premise of value. You need to understand the drivers of value. You need to be able to tell the stories that's driving the numbers when you are conducting valuation. And for those of us that are interested in the masterclass, if you go to the next slide, you can scan the back code. It's going to give you details of the masterclass. Majorly, we'll be delving into business valuation. We'll spend some time looking at how to conduct financial statement analysis. How do we? What are the approaches? And usually, it's always we had the first one last year at the Pan-African University at the Lagos Business School. And we had live cases where we together solved we conducted evaluations together with the participant at the session. So you can I'll leave this for about 30 seconds for those of us that are here to scan it and register to join the session if you would like to attend. Then I'll hand over back to Tejiri and Tomiwa for the questions and answers. Yes, the program curriculum is on the website. If you go in there, you're going to see the curriculum. Thank you.
Thank you very much, Sulaiman and Tejiri. I'm sure the audience will agree that it's been an insightful and educative session. So it's time to take questions and answers. And I'm just going to go through, because I know I've been seeing questions in the Q&A room. So I'll just go through those questions and would try as much as possible to provide answers. This first question goes, how do you value a tech company whose competitors' financial statements are not publicly available? Sulaiman, do you want to answer that?
Yeah. Thanks, Tomiwa. I'm happy to take it. So for businesses, whether tech companies or financial services or healthcare, yes, there will be businesses whose direct peers that you think are peers whose information are not available. But I can assure you, outside the shore of Nigeria, you will get peers whose financial information are available. All I need to advise is you make necessary adjustments for country risk, for size risk, and for some firm-specific risk. For instance, if you realize that the business is still in its very early growth phase, and the peers you are looking at as sort of reach stability, then you make adjustments for that. So that's the response to that in a nutshell.
Thank you for that. Another question goes, if price can be affected by sentiment, whereas valuation is the throughput of the business, can we really say they are the same? I know this question is coming from, what valuation is. And we had mentioned price, so this person wants to know if they are truly the same.
Yeah, thanks, Tomiwa. So I will say it's a tricky one to answer. Price and value are about the same, but in some instances they can be different. And when there is diversion for that, right, and that's when we see that That's when we talk about the whole whether it should be a buy or a sell and all of that, right? But if you look at the concept of market efficiency in the first place, right, you realize that prices and by extension value, especially in a semi or a weak efficient market, will usually deviate from the intrinsic value, right? However, in an efficient market where the prices quickly reflect all information, whether past, present, and future, right? Where technical analysts or fundamental analysts cannot really thrive or make any excess return, then you say price is the same thing as value. I believe that answers your question.
Yeah. Okay. This other question, are business valuations done when you want to buy or sell a company or business? What other reasons can call for valuation? Okay, I think this one, we had spoken about this earlier. It could be for it's not just M&A for M&A purposes. Financial reporting purposes, for instance, you want to revalue assets, you want to compute your goodwill. Other reasons, even in litigation, say the turnaround and restructuring litigations, in divorce cases, for instance, you want to divide inheritances, you could do evaluation for that purpose. In tax and regulation and for regulatory compliance purposes, say transfer pricing for related party transactions, you want to value cross-border transactions and assets. Right. Okay, so let's go to the next one. What is the best source of data for business valuation purposes for a business that is yet to start operations and looking for potential equity investors?
Sorry, can you take the question again, Tom?
So this person wants to know the source of data for businesses that are not yet in operation.
Okay, so as I mentioned earlier, I mean, I will imagine you're talking about startup. You're valuing those businesses. I mentioned earlier, they are interesting businesses to value, right? Again, what you have in front of you to value is a PowerPoint. But over and beyond the PowerPoints and the conversations, you are also valuing the management team, the success of the guys that's driving that business, what he has done in the past, and more importantly, in terms of how you source the data, one thing you need to know is the founder or the promoter of that business would have put together his market expectations. And there are different ways to assess this. You check in the market size, he's done the market sizing, he's told you how much competitors are charging. Those are different ways of sourcing the data. But over and beyond all those drivers of performance of the business, of the new business, in terms of the valuation or the key valuation data, there are different sources that we rely on to get all of those. There is a Capital IQ, there is a Damodaran website. There is a lot of sources that we rely on. There is Bloomberg, the Nigerian Bureau of Statistics provides all of those informations and all of that. So you need to be able to get the industry information, the macroeconomic information, and the likes for you to eventually derive the value. Thank you.
Thank you very much, Suleiman. There's an interesting question here. I often see in the news a startup that was valued over $1 billion a few years ago, and now worth less than $1 million later. And I wonder if this was due to wrong valuation by the valuer or the management.
Well, it's an interesting question, I think, and maybe we should say the media might probably there might be some selective bias where the one you've seen are the ones that they were 2 billion before and then they are now $1 million. There are millions or hundreds of those that were 2 billion at some point and also 5 billion now or a year after. So different things drive value. It's really around the quality of management, the when they put projections in front of you, projections is just is meaningless if there is no execution. So, and really, when we conduct valuation, one of the things we look at is the execution risk, right? The guys that says they want to do this, have they done it before? Do they have the drive to do it? Do they have the capacity to deliver on these projections? So when you put all of that together, if you realize that it appears overly ambitious or appears unreasonable, then you do all of the analysis and adjustments to derive the cash flows that you consider reasonable. So I won't say the evaluation was done in a wrong way. I would say it might be, in some instances, market moving against the company, right? In some instances, it might be the management not executing what they've set out to execute, or it might just be things completely different that you and I are not privy to. But also, please bear in mind that as you've seen one or few that showed decline in value, there are millions that also resulted in increase in value. Thank you.
Thank you, Sulaiman. I think we'll just take maybe one or two more because of time. This one says, for precedent transactions, is it a must that you consider recent time transactions than old transactions?
Yeah. Thanks, Tomiwa. I won't say it's a must, but what's important is looking at the time period. Have there been events that happened that made the whole transactions to be meaningless or to be unreliable? Maybe there has been a regulatory change, or there has been a significant change in industry dynamics that makes the transaction multiples during that period to be different. For instance, let's say you are valuing a business. Let's think about the industry that was mostly affected by COVID. In fact, let's put transport. Transport during COVID or before COVID, we're all on the road, Monday to Friday, coming to the office. And post-COVID, you only go into the office, say, 2 or 3 times, or some people don't even go at all. They work 100% at home. So if you value a business before that, and then after that, it might not be applicable. It might not make sense to use transactions before that. I mean, and there are different industries that might reflect or that might be more impacted. I mean, look at it from tech, for instance. If you're valuing, say, Microsoft, for instance, before COVID, video conferencing and all of that wasn't really popular, right? And then transactions before that might not really account for these upsides. But after COVID is a different thing entirely. So what's critical is look at the time period. Have there been changes that rendered the previous transactions unreliable or not? Thank you.
Thank you very much, Sulaiman. For lack of time, we might not be able to go through all the questions, but I see some questions here, some questions around if we can value or how we can value digital assets companies, how we can value intangible assets. All of this and more will be treated very well at the Corporate Valuation Masterclass later in September. But for now, I would like to thank every one of us for joining and being such an amazing audience. I'll hand over at this point to Mr. Shegun to give us the closing remark.
Thank you very much, Tomiwa, and thank you everyone, from TJ to Sulaiman. Thank you so much. I'm sure it's been a wonderful session. I've learned a lot, really, a whole lot. If you think you realize that every day you keep learning and getting new information. All right. If we've gotten value, if we think it's worth our 2 hours, I want the fire emoji in the chat box, please. Just go there, give your thumbs up, appreciate the professors and everyone. If you think you did get value from this very session, I want to see a show of hands. Yeah. Thank you. Great, great, great. Let's keep it coming. Let's keep it coming. Let's keep it coming. Okay. Thank you so much. So, you perhaps must have been seeing in the chat box. We've been sending details about the valuation masterclass, and you can also have it on display on our screen. That is happening on the 2nd of September here at the business school. If you think you've gotten value, imagine what is going to happen at the session. It's a 3-day session happening at the business school, and it's hybrid, right? So perhaps you are out of the country or out of Lagos. You think if you're not physically present, you can't be a part of it. No. So a hybrid facility allows you join from any part of the world. Should you not even be in Lagos, Nigeria, right? So you have the opportunity to connect from any part of the world. One good thing I also would like to share with us, really, because this is an experience from the last session, and that's why we're having the webinar coming, much early compared to the period we had it last year. So we had a situation where, um, a lot of prospective participants who would have loved to be a part of this program couldn't because they were unable to secure an approval in time from the organizations, and that delayed, and some of them couldn't join us. For those also, some of them also gave us a feedback that they would like to be a part of this, but the financial commitment, considering the time, wasn't feasible for them to commit to, and we responded to that, even though it's work in progress. But I'm certain that before the program starts um, in September, we should have put that in place. We started already. It's just about closing it. We are almost at the last phase. So we are providing a flexible payment, you know, scheme such that you don't have to commit to the, program wholly, right? Pay outrightly for it. So we have a third party organization that is in partnership with us. And what they do primarily is to ease off the burden of making a one-off upfront financial commitment to this or any other program you may perhaps be interested in. And what it does primarily is that it allows you to spread payment over a period of time, say 6 months, for instance. So instead of having to make an upfront payment at a go, it allows you spread payment over a period of time. But like I said, it's still work in progress. But um, we are definitely certain this is going to come in place before the program starts, and we then definitely inform everyone. I've seen a number of questions as to whether or not the presentation is going to be made available. Yes, some of you said you're having network issues. So, to your question, yes, we are going to make the presentation available. The slide, not sure, but I mean, you're going to get the presentation, the recording of this presentation. You're going to get that latest Monday rather. You're going to get that from us. I want to thank you on behalf of both institutions, Lagos Business School as well as Deloitte. I want to thank everyone that has participated at this very webinar 2.0. We want you to, stay in touch, and then we look forward to having you all at the Corporate Valuation Masterclass come September. Thank you, and do have a great afternoon. Bye, everyone.